Hello everybody. This time we are talking about investment decision. An investment decision, also known as a capital budgeting decision, is the process of allocating financial resources to various assets or projects with the goal of generating future returns. This crucial aspect of financial management involves assessing potential investments to ensure that funds are utilized effectively and strategically. And then we move to investment decision process. The first process: assess your financial situation by taking income, expenses, savings, investments, and debt into account. This assessment will also give you a good idea about how much risk you can take. Second step: clearly define your financial goals. This will also give you some clarity on your investment horizon. Third, it's time to do your research. Gather information about different kinds of assets such as stocks, mutual funds, real estate, and gold. Decide how much to allocate to each asset based on your financial goals, risk tolerance, and investment horizon. Fourth, compare different investment vehicles and create a diversified portfolio. For example, when you are comparing stocks, evaluate metrics like earnings per share, price to earnings ratio, dividend yield, and market capitalization. Similarly, when you are comparing mutual funds, it's important to assess factors such as the fund's expense ratio, past 3, 5, and 7-year performance, risk adjusted returns, and the experience of the fund manager. And then, fifth, lastly, it's important to regularly review your investments. As market conditions or your personal financial situation changes, make adjustments to your investments in your portfolio to make sure they stay aligned with your financial goals and risk tolerance. And then we move to factors affecting investment decision. The first factors: investment objective. The purpose behind an investment determines the short-term or long-term fund allocation. It is the starting point of the decision-making process. And then second, inflation rate. In financial management, investors look for investment opportunities where returns surpass the nation's inflation rate. Third, return on investment. Managers prioritize positive returns. They try to employ limited funds in a profitable asset or security. Fourth, about liquidity. Investors are often worried about their emergency funds, the provision to withdraw money before maturity. Hence, investors look at the degree of liquidity offered by a particular asset or security. They specifically consider withdrawal restrictions and penalties. Fifth, return frequency. The number of periodic returns an investment offer is crucial. Financial management is based on financial needs. Investors choose between investments that yield monthly, quarterly, semi-annual, or annual returns. And then, what are the different types of investment decisions? Investment decisions can be categorized into various types, including the first, capital budgeting, deciding on long-term investment in fixed assets or projects that yield returns over time. Second, individual investments, making decisions on specific investment opportunities such as stocks, bonds, real estate, or commodities. Third, portfolio management, allocating funds across different financial instruments or assets to achieve diversification and optimize risk-adjusted returns. And fourth, strategic investments, identifying and evaluating investments that support the company's strategic objectives, innovation, or growth initiatives. And then we move to scope of investment decisions. The first scope, selection of right assets. Investment decisions help in choosing right type of investment and for deploying the funds. Each of available opportunity is properly analyzed by management while taking investment decisions. This way, every aspect of asset available for investment is taken into consideration, which leads to building up a strong portfolio. Second, national importance. These decisions are of national importance for a nation as it leads to overall development and growth. Investment decisions taken determines the level of employment, economic growth, and economic activities in a country. More amount of investment creates better supply of funds in an economy, which increase the pace of overall economic development. And then third, identify degree of risk. These decisions help in identifying the level of risk associated with an investment opportunity. Decisions are taken on the basis of expected return and risk required for earning such return. Managers properly evaluate assets using various tools for finding out the risk while taking investment decisions. And then fourth, enhance financial understanding. Investment decisions impart large amount of beneficial financial knowledge to individuals taking these decisions. Investors, while choosing the asset, uses a variety of tools and techniques for analyzing its profitability. It provides a lot of information which enhances the overall financial knowledge and enables investors in taking rational decisions regarding investment. And fifth, determines firm profitability. Decisions regarding investment plans determine the future profit earning potential of a firm. A right decision may bring large amount of funds to an organization, leading to better growth, whereas any wrong decision regarding deployment of funds may cause heavy losses and even adversely affect the continuity of the firm. I think it is enough. Thanks for watching.